All right, let's dive into this. If you're here, you're probably wondering if energy transfer is worth your money or if you should just let it ride. Stick with me and I'll break it down in a way that makes sense. By the end of this, you'll know if ET is something you want in your portfolio or if you're better off looking somewhere else. So let's talk about energy transfer and why it's still one of the best plays in the midstream oil and gas sector. I know oil and gas can be a bit of a roller coaster, but here's the deal. ET isn't just hanging around hoping oil prices don't tank. They're growing, they're expanding, and they're making moves that are setting them up for both near term gains and long term stability. And when I say growth, I don't just mean slapping a band aid on their business. I'm talking about serious, smart, long term growth. Personally, this is my favorite dividend stock. Let's start with some hard numbers, okay? Because nothing convinces like the facts. ET reported their second quarter earnings for 2024, and guess what? They knocked it out of the park. Their adjusted EBITDA came in at 3.76 billion, which is a nice jump from the 3.12 billion this time last year. You adjust for the typical stuff like M&A expenses and whatnot, and you're looking at 3.8 billion. Now, if you're wondering why that matters, it's because EBITDA is the lifeblood of companies. It's what they use to pay their dividends, funds their growth, and maybe even buy back shares. Speaking of dividends, that's where ET really shines. You're looking at a yield close to 8%, which is nothing to sneeze at. That kind of yield backed by these numbers is like getting paid to sit back and hold. Sure, the price might fluctuate a little, but the dividend is locked in because of how much cash they're pulling in. And let's not forget the most important part, growth potential. ET's not just sitting on their hands and waiting for the market to decide its fate. They're reinvesting that cash into things such as M&A, organic capex, and new projects. Some of these projects won't even start making money until 2025 or 2026, which means there's plenty of future upside back into the stock. Let's even break it down further. When you're investing in a company like ET, you've got to know where the money is coming from. They've got several key segments, and every one of them is doing pretty well. First up, their NLG and refined products segment. It pulled in 1.7 billion EBITDA for Q2. Last year, it was sitting around 840 million, so that's a solid jump. This growth mostly came from project and transportation and fractionation, plus a little help from some hedging activity. It's not a one-off. This is a sustainable growth. Next is the midstream segment. These guys pulled in 693 million in EBITDA, up from 579 million last year. What caused this bump? Well, ET picked up some assets from Crestwood, and the acquisition is already paying off. And then there's the crude oil segment. This one grew 18% year over year, thanks again to smart acquisitions like Lotus and Crestwood. Even if you strip out the acquisition, the segment would still be up 4%, which tells me the base business is solid and they're not just relying on deals to keep the lights on. If you're still with me, let's talk about what's coming down the pipeline. Take their gas-fired power generation business, for example. ET's already running about 185 plants across 15 states, and they've already added more. They've signed deals to push over 500,000 MMBTUS of gas per day, and they've already got 8 new 10 MW units approved. These deals are happening now, and the groundwork is already laid. They're positioned in growing markets like Florida and Texas, and they're tapping into new industries like blue ammonia and even crypto mining, which, love it or hate it, is still a thing. They're smartly diversifying their revenue streams without going too far outside their lane. Now, here's something else that caught my eye with them. ET's management isn't just throwing money at random projects and hoping something sticks. They've been very calculated about where they're putting their capital. They just raised their full year adjusted EBITDA guidance to somewhere between 15.3 billion and 15.5 billion. That's up from the previous guidance. It shows that they're confident in where they're heading. But here's where things get really interesting. Despite all the growth and all the projects they're funding, they're keeping their capex conservative. For 2025, they're estimating around 3 billion in organic growth capex. That's the same ballpark as what they're spending this year, 3.1 billion. And given they're pulling in around 15 billion in EBITDA, there's plenty of cash left over for other things like reducing debt, buying back shares, or even juicing up the dividend. In fact, Moody's just upgraded ET's credit rating to Baa2, which is a solid investment grade. That tells you they've got their debt situation under control, which is huge for a company that's been criticized in the past for carrying too much leverage. They're not out of the woods just yet. Their debt is still a bit high at 4.2x EBITDA, but they're clearly making strides in the right direction. So what could go wrong with them? Well, all right, let's not get too ahead of ourselves, right? There are always risks, and ET is no exception. The big one? Commodity risk. If oil or natural gas prices take a nosedive, ET could feel the pinch. That said, about 90% of their cash flows are tied to fee-based contracts, which gives them some cushion. These contracts have preset pricing, so even if the oil market goes south, they've got a safety net. And their other risk, like I mentioned, is the debt. Their leverage ratio is still on the higher side at 4.2x, which could be a red flag. for some investors. But with their internal cash generation, they're in a solid spot to keep chipping away at it. And remember, they just got an upgrade from Moody's, so they're clearly making progress. So the valuation. Is ET a steal? Now, let's talk about where ET stands from a valuation perspective. On an EV/EBITDA basis, they're sitting at 8.25x. You're not just getting a strong dividend, you're getting a company that's undervalued relative to its competition. So, to put it simply, ET's current multiple is a steal. You've got strong cash, growing projects, and a management team that knows what they're doing. Plus, the stock is trading at a discount, which means there's a real chance for a price appreciation alongside those fat dividends. The bottom line. So, where does this leave us? Energy Transfer isn't just a dividend play. Sure, the 8% yield is great, but this company has way more going for it. They're growing, they're making smart acquisitions, and they've got a pipeline of projects that'll keep the cash flowing for years. Their debt's going down, and they're trading at a discount to their peers. So if you're looking for a stock that pays you well today and has serious potential for growth tomorrow, Energy Transfer is worth a long, hard look. Whether the oil markets tank or not, ET has positioned itself to ride out the bumps and keep delivering for shareholders. Thanks for sticking with me through this. It was a long one, but if you're as excited about Energy Transfer as I am, maybe it's time to take a closer look yourself. Just make sure to do your own homework before making any moves. Because while ET looks strong, you've always got to know the risks, right? See you next time.